Welcome to Podcast, the Business of Dentistry podcast, brought to you by Practice Plan. Podcast delivers the best business advice, real-life stories, and practical hints and tips to make your practice a more profitable and sustainable business. And now, here's your host.
Well, hello, my name is Nigel Jones, and I'm delighted to welcome you to this latest edition of the In the Loop podcast series from Practice Plan. And today I'm particularly happy because I've been joined by Mike Blenkharn. Hi, Mike.
Hi, Nigel. How are you doing?
Yeah, I'm good. Thank you. So the sort of topic that we're going to be exploring today is around exit strategies, and we'll spend a little bit of time talking about actually the fact that that's something you need to be thinking about very early on in your practice ownership career. But just so that those people that are maybe less familiar with you and your role and your experience in this area, I wonder if you could introduce yourself.
Yeah, of course. Yeah. So my name's Mike Blenkharn. I'm a partner and head of dental at UNW LLP, which is a firm of chartered accountants based in the northeast of England. We act for about 500 dentists, which are dotted all over the country. And my role as a partner of the team is I am responsible for helping people buy and sell practices, their general affairs, but also tax planning and restructuring. And it's a role I've been doing in respect of looking after dentists for about 15 years now. And with 10 of those years spent at a previous accountancy firm, and then the last 5 years spent at UNW.
Excellent. Well, I'm delighted you could join us to share what you've gleaned during those 15 years. And I know it'll be very useful to the audience. So I sort of alluded to this in my opening remarks. But when it comes to exit strategies, what's your counsel to people as to when they should start thinking about them?
Oh, it's a good question. It's the short answer is as soon as possible. And I was chatting to a dentist who recently bought a practice. This was back in May, and I didn't help them buy the practice. They approached me afterwards because they wanted to understand how to run their practice profitably. And I asked them one question about the purchase, which is, did you consider your exit? And this is a young dentist and her husband, and she looked flabbergasted that I'd asked this question when she was at the very start of her practice ownership career, and for all intents and purposes, wanted to own the practice for at least 15 years. So for me to come along and ask about something which might happen in 2 decades' time or 15 years' time, she was taken aback. The reason I ask that question, the reason why I'm building that type of exit strategy planning when I help people buy a practice, is you can structure the business in a certain method, a certain way, which would not only provide annual tax savings when you do own the practice, but give quite a lot more flexibility when you come to sell the practice. So it could be, when I'm talking about structures, generally limited companies, it could even be a partnership. But it's just making sure that you get the structure right from day one, so that you save on bank arrangement fees and legal fees, accountancy fees. So if you get that structure right, it's generally more efficient.
Yeah, that makes perfect sense, that you need to be starting to think about these things early on. And I think that you probably encountered scenarios where you save people an awful lot of money.
Oh, absolutely, yes. If we take a very kind of vague example, but just to put an example out there, if somebody wanted to apply a holding company structure to their limited company dental practice operation, so by that I mean the limited company is your dental practice is operating as a limited company, and the dentist and potentially the spouse and family members are shareholders of that limited company. You can use a holding company to own the shares in the trading company, and that provides significant tax benefits on exit, i.e. there's normally no tax to pay when the holding company sells the shares in a dental practice company. Now, if you set the structure up as a holding company that owns the shares in a trading company, you set that up from day one before you buy the dental practice, the cost is peanuts. It's a few £100 to set up that holding company and have the shares organised in that manner. If you try and change the structure once the business is trading, the fees alone on the accountancy, tax and legal fees, as well as the work that's needed, can be a 5-figure sum easily. So let's call it around £20,000. That could be £20,000 saved if the dentist shares their vision with their advisors, and the advisors prompts the dentist to share their vision. Because that's what it is really. All I'm asking about exit strategies is, what's your vision? Where do you see your future being? And can we build some flexibility into that? So that the savings are generally on changing the structure, and set the structure right from day one, and then actually you'll save significant.
Yeah, that makes perfect sense. And I'm a great believer in Stephen Covey and his 7 Habits of Highly Effective People. Begin with the end in mind. Yes. Seems to be a very pertinent one for this scenario. And I guess, I mean, most of the practices I've worked with, I have to be honest, an awful lot of the owners wake up one morning and decided they've had enough. So they then contact someone to help sell their practice. A strategy would be quite a glamorous term for what they're doing. So let's say that they've begun with the end in mind, and they've got a vision, they've got a view about where they want to take it. And they're getting to the end of that 2 decades that you were talking about with that previous client. But how far out should they be really earnestly thinking about the detail when it comes to exit?
Quite honestly, I've been parachuted into deals, and I'm not going to call it a strategy, because it's more a very short-term adjustment to try and add more value to a deal. But I've certainly been parachuted into deals 2 weeks before someone's due to sell their practice, and you can still do some tax planning and still do some mitigation of a tax to increase it, either increase the value of a practice or decrease the cost. The tax on sale. So that's your broad spectrum, is help somebody buy the practice with an exit strategy in mind, or you can even add value and reduce tax a couple of weeks before completion. Very generally speaking, what I say is it's a 7-year process. It's an ideal timeline, so minimum 7 years. And that accounts for the run up to sale, the sale process itself, but also factors in burnout or tie-in periods post-sale. Because it's very unusual that a dentist's sale of practice is actually going to be their retirement from clinical work. They're quite distinct, different dates normally. So the 7-year timeline starts with having a 3 years before sale, which means that we can review profitability, benchmark the practice, absolutely screw out the maximum amount of profit you can from that business model. You're looking for cost savings, you're looking for the ability to grow revenue. And if you can do that in a 3-year period, then you will achieve optimum performance prior to sale, and you'll have demonstrable accounts to show that as well. So you'll have year-end account prepared by accountants, which will show a higher profitability. And I know we're going to talk about it later, but profitability drives value, and ultimately that will drive the proceeds you receive from sale. So that's your 3 years. The 12 months is broadly about the timeline for putting the practice on the market and you to complete it on the transaction. And again, you can add value into that by looking at what you're selling, how you're selling it, and what's included in the sale. And that's all an accounting and legal aspect in respect to the purchase agreement. And then the 3-year tie-in period afterwards, that gets you to your 7 years. So if a dentist woke up this morning and said, I want to retire in 7 years, perfect. We've got a very, very good action plan which we can put into place with proven results, and that will deliver the result that dentist wants.
Yeah, that makes so much sense. And there is 2 or 3 things that I'll pick up that are related, but slightly separate points in what you were answering there. But the first thing I was going to say was, you mentioned about adding value, and you had a nod towards profitability. So we'll get to the profitability bit in a second. But for those people that may be less familiar with how practices are valued, how is that typically done these days?
So practices are valued on a multiple of an adjusted profit. So how this works is, everyone will have seen their profit and loss account for their dental practice. So you have your income less your expenses, that gets you to a profit. Now that profit has to be adjusted for various elements, and the first element it's adjusted for is any interest costs and income, any tax, any depreciation, and any amortization. And that is commonly known as EBITDA, so earnings before interest, tax, depreciation, amortization. There's then a further adjustment that you do to that, and that can be called adjusted earnings or adjusted EBITDA. But essentially what that does is it further depersonalizes the accounts. So in a set of accounts, your accountant will say, let's put a use of owner's office charge through the accounts, or let's put your motor vehicle through the accounts. Well, any buyer of a practice won't necessarily incur those costs, so you can add those costs back to boost your adjusted EBITDA figure. And then the final adjustment is if the principal is clinical, and you should do an adjustment to basically include a cost of an associate having to do their clinical work. Once you've done all of that, that will get you to an adjusted EBITDA figure, which you then apply a multiple. In the industry, average is somewhere between 3 to probably the heady heights of 7.5, 8 times EBITDA, so 8 times that adjusted earnings figure. So if your adjusted earnings, your adjusted EBITDA figure was £200,000 and the multiple was 7 times, you would get 1.4 million.
Okay, excellent. And what influences that multiple then? You describe quite a range there from 3 to 7.5 or 8. What puts it at which end of the scale?
You can probably tell from my accent that I'm northern, and more specifically, I live in the Lake District. It's an absolutely lovely place, but it is so difficult to find associates. Generally, there's potentially less affluent people, and very broadly speaking, there's less demand for practices in the district for those reasons. You take a practice in London, where there's plentiful supply of patients, of dentists, and other clinicians to do work. There's a huge demand for practices there. So it is generally supply and demand that generates that EBITDA multiple. So the very worst case scenario would be an NHS practice in Cumbria could be at 3 times EBITDA. A high-end cosmetic or private practice in London could be at 7.5 to 8 times EBITDA multiple.
Yeah, and you touched on an interesting point for me there. Obvious reasons given my role at Practice Plan, but the NHS example that you just gave there, given the current workforce challenges and the difficulty of recruiting and retaining associate dentists and dental nurses and therapists and hygienists, but let's say associate dentists at the moment, is that's why it's difficult for an NHS practice to go up the multiple scale?
Absolutely, yes. So when you're talking about selling your practice, you have to consider who's going to buy your practice, because ultimately, if there's no buyers, you're not going to sell your practice. So let's take a typically 2-3 surgery NHS practice with an average UDA rate, say £31 UDA. There's an inherent lack of profitability in having a low contract value, particularly in times when you've got rising costs. We all know about the national minimum wage increase. We all know about the employers' national insurance increase. All those elements mean that you've got increasing costs and a fixed income. So that 2-3 surgery NHS practice with a low contract value is going to have a low profitability. And generally speaking, the demand for that type of practice is low. So you're applying a low demand to a low, generally speaking, low profit practice will mean that there's a low multiple applied to a low figure. That means it's probably at the very bottom of that kind of values list. What I will say is, particularly with NHS practices, it's the UDA rate drives value, drives goodwill values. And I know this because I prepare the National Goodwill Survey on a quarterly basis. Very generally speaking, there's not that many NHS practices sold, proportionate to private and mixed. And that's indicative of a trend of people desiring private and mixed practices more. But some NHS practices do sell well. They've got a good contract. It's all based around this NHS contract, which as a principle you have very little control over.
Yeah, that's interesting, isn't it? Because it shows how the dangers of generalising and saying NHS practices are this and private practices are that. There's enough variables in there that you've got to be slightly wary of that. But sort of taking that idea on a little stage, you did mention in one of your earlier answers about focusing on profitability, and obviously that links to the valuation equation that you've been describing to us. So if you've got that call after someone has said in 7 years' time I want to exit, how do you approach maximising the EBITDA to therefore maximise the value?
So we've got a systematic process, which is a getting to know your client. So the first port of call is the most recent year-end accounts, and we will do a benchmark on those against national averages for whatever type of practice it is, so be that NHS, mixed or private. We then look at where the potential cost leakages are in the practice against the averages to understand where there may be savings. Because if you can save on outgoings, then you're boosting profits. And if you can save 10 grand on materials, then you're potentially adding 70 grand in value to your practice. Then the other side is understanding how that practice operates. So how much white space is there in diaries? What is the operating cost per surgery per hour? And then using that and adding a profit margin. What does that hourly rate look like at the practice? How often have they done a pricing increase? Elements like that, what is a mix of clinicians? You can really quickly understand if there's any easy wins, any low-hanging fruit, and what is some further work that the principal may need to do to change how their practice works.
Yeah. And how, when I think about those changes, I mean, listening to you talk, Mike, I mean, I've spent years talking to practices about the importance of business measurement, and you can get them very excited about clinical measurement, but getting them excited about business measurement can be pretty tricky at times. So if you're going to start gathering the data, I guess that starts eating into your 7 years.
Yes. Ideally, what you would have is a plateau of 3 years of the highest performance you can achieve. And then you basically take those 3 years of accounts to a sales agent. However, with the increase in technology used in respect of accountancy systems and bookkeeping software, you can also rely on management accounts. So let's say someone went on the market today, or was looking to put the practice on the market today, and they had a March year end. There's a strong chance we probably won't have a March 25 accounts. The last set of accounting prepared accounts could be to the 31st of March 24. But if they're using accounting software, they will have live data as to how that practice has performed since the 1st of April 24 through to the 11th of June 25. So it's important to make the changes as quickly as possible, because any buyer, when they perform what we call their financial due diligence, i.e. lifting the bonnet of the practice and seeing exactly what the numbers are and how the practice is performing, they will want to see consistent performance across 3 years, or certainly more than 1 year. However, you can make changes, quite instant changes, which means that your first year you won't see that big increase in profitability, but the final 2 years after that you will, and that's in that 3-year period. You also have the ability, and we've just done that as well on a sale we advised on, is we were able to sell the practice based on forecasts, which is almost unheard of. It was a very specialist practice, but we were able to quantify the changes the practice had made, which affected their profitability and how that was going to extrapolate forwards. And the buyer was happy with that justification and the financial data provided. So really, make changes as soon as possible with the view that you want to justify that in at least 3 years of accounts. But as long as you make the changes and those changes are feeding through to even the management information you have on a weekly basis, then that is all evidence to the buyer that what you're doing is having a positive impact on your business.
That's interesting you're talking about the forecasts, because then that marries together some hard data with a narrative that sounds plausible, I guess.
Absolutely, yeah, because I think a lot of buyers want to understand the story of what's happening in practice. The numbers are a metric to measure that, if that makes sense. If they can understand the changes they've made, and if that's in line with how they would want to run the practice, then actually the seller's done quite a lot of the hard work already. And the numbers will, that is a result of the changes. It's just nice to have that quantum, that financial reassurance in actual data that changes have had an impact that long term.
So just to expand on that a little bit, you used the phrase due diligence before. What are the other sorts of documents or information that might make up a due diligence pack?
So really it's and I used the phrase before, getting under the bonnet. So due diligence will start with a set of accounts or 3 years of accounts. And what we'll find is we will interrogate, certainly if I'm acting for a buyer, we will interrogate costs in the accounts. It could be materials costs, it could be lab costs. more specifically wage costs. And I undertook a process for a client where the accounts, I think, were a 2024 year-end account, so they wouldn't have taken into account the increased employers' national insurance and the increased national minimum wage. So what we do is we do a forecast to adjust those costs to be as they would be once our client has bought the practice, because what they're inheriting is government-led changes which are not under the control of the practice owner, i.e. writers. So you do that almost on a line-by-line basis for the profit and loss. But you also look at what the liabilities of that business are if it is a share purchase. If you're buying the shares in a limited company, or conversely, if you're selling the shares in a limited company, what someone is doing is buying shares in an active live company which has inherent liabilities. And legally, you'll do your best to make sure that you're protected, but you still need to understand how that business operates and what might come out the wardrobe, what skeletons might come out of the wardrobe under your ownership. So it's really just that detailed financial.
Well, look, we're coming to the end of our brief conversation on this. I suspect that we'd be able to talk for an awful lot longer, Mike. But are there any sort of closing thoughts or closing comments you might have for anyone that's listening in?
Yeah, it's never too soon to look at exit, and similarly, because I've said, look when you buy in, or look, at least 3 years prior to selling your practice. If you're a year away, it doesn't mean it's too late. Do speak to a specialist dental accountant. They will help you boost the value of your business. It's just we prefer a bit more time so we can do more sophisticated tax planning.
Okay, excellent. Well, look, thank you so much for your time, Mike. Really enjoyed the conversation, as always, actually, and just value your expertise and your knowledge. So really appreciate you giving up the time today.
Great. Thanks, Nigel.
Thanks a lot, Mike.